Here we have the original consolidation, the rally up. And I want you to pause, take a look at all the price run from here up to here and then down. What do you see? When you're looking at this, my eye sees this. Return to the original consolidation. The market rallies up. We have a down close candle that's just below this area right here. What does this up close candle become? Bullish breaker. Low, high, lower low. Down close candle inside of the breaker candle over here. That's a bullish order block right there. So when it rallies up and trades back down in, our target is what? Up here. The initial draw is the liquidity above that high and the older high to the left. It's not inside this fractal price action anymore, but it's highlighted with this line. So this drop down, that could be, if you're not seeing the original consolidation correctly, and this would be your original entry or your first stage accumulation. And then this would be second stage reaccumulation here, and it rallies up. But if you don't, for the sake of those individuals that wouldn't have it identified correctly in terms of how big the original consolidation is, when it leaves it and then comes back down in, I'm making an allowance for that for this lecture here. So you might not have that skill set in the beginning to see exactly how to define the consolidation. Then if that's the case, then the bullish order block here would be your first stage accumulation for you. Is it wrong to classify it this way? No, it's based on your understanding. They're both correct based on the level of experience and knowing what you're doing. The only distinction is how you may or may not have had the original consolidation mapped out right. So many of you may not have seen this as a return to the original consolidation. You may have seen this as relative equal highs being taken, and now it's going to go lower, not knowing all the other narrative that I've outlined here. So down close candle here in the scope of a bullish price run during buy side delivery, aiming for this area up in here. The down close candle is traded to here. So there's your entry for a first stage accumulation, or it would be second stage reaccumulation if you use this as your first entry. So again, just make sure you understand that. Sometimes you will only have one point of accumulation and not have a return to original consolidation. It might just rip higher, give you one opportunity to go in, and then run real quick to it then. And then after that, bleed lower. So it has a lot of different variances to it, again, which is why I said that you have to understand everything that I teach to be able to be well versed with trading market maker models. That doesn't mean that you can't see a very generic, plain as day, obvious market maker sell or market maker buy model. When it's in the price action and it's obvious, it's real easy to see it. But the potential for more of them to be there and in your fingertips to be able to reach and see, I can see more setups now, that's going to increase over time. Okay, so just understand that. So what have I said here so far? Well, you have an opportunity to be a long entry here or a long entry there. So there's two setups. Which one of these, without going any further so far, which one of these would make sense for you as a trader right now with your present understanding? Obviously, it's a rhetorical question because I can't obviously get the response from you here. But I want you to think about that because I have some traders that would only be interested in taking this as their entry. And if they never get a return to the original consolidation, they're not long. Others want to see that, then it rallies, and in the next buying opportunity, as long as we don't get to the target up here, they're willing to take this as the first stage accumulation. And that's their entry. And then they ride it up into that target. They may or may not have the ability or interest in trying to go short at that time. Other traders can identify this as the first stage accumulation, maybe not see this one down here, and they see this and they want to wait to see if price rallies up to that point. Then they use this part as their model where they go short and they pyramid in here, here, and wait for the run below here. And don't even consider something like down here. Is that wrong? No. I have other students that want to see it do this, then really prove it wants to go lower, and then they'll trade that one right there and then go into that. That's a unicorn. Okay, unicorn is second stage redistribution in a sell model, market maker sell model. Now, when I say unicorn, meaning everything's in your favor, you got everything behind you. It's just so one-sided, and you can see it. It's usually the most energetic swing high that it drops down from. If you've classified everything correctly and everything to the left on the buy side of the curve is identified correctly and you have everything labeled right and you have time and price in agreement with you, chances are you're probably going to ride the lightning, which is really quick, sudden drops, and it's real fun to be in those low resistance liquidity runs. But that's one of the most qualifying factors in my trading and how I teach it to my students is to find the easiest high speed, low resistance liquidity runs. They're going to always be the second stage redistribution in a market maker sell model, which is what this is right here. Okay. So if you miss this one, this is also what I teach, which is a buy side imbalance, sell side inefficiency, consequent encroachment, which is the midpoint of this inefficiency. Did it get to this level up here yet? Nope. So this here is a bullish fair value gap, consequent encroachment, second stage reaccumulation right there. Now, for some of you, you might be going long in here and then adding and pyramiding to that to ride into this level here. That might be your trade. Is there anything wrong with that? Nope, absolutely not. Others that are high-end students that have been doing it for a long time, they're going to sell these mohawks because the bodies are already indicating that what? It's not one to go outside of that 60-minute fair value gap, SIBI. So every rally up here, they're going to go short. And anything outside of that PD array's high, which is the 60-minute fair value gap, that's an extremely overbought, without an indicator, entry. And you've seen me do that in my executions. You've seen me do that with my pyramid entries. You've watched me trade just outside of the fair value gaps when I'm bearish or bullish. And it becomes usually within a tick or two from the actual highest high or lowest low of those individual candlesticks. And then it starts running the direction I need to go. This is what I refer to as a smart money reversal. You are years away from ever being able to do that consistently. I promise you that's not me trying to talk down to you. It takes a great deal of understanding of knowing what it is that we're trying to do here, because essentially what you're doing is you're picking the tops in bearish markets. Now, did you hear what I just said? We're picking the tops in bearish markets. I'm not afraid of that. I don't try to discourage that of my students, but I do absolutely discourage that in my own trading. When it's a bull market, I'm not trying to pick the top, because they're always going to go well beyond what I think and what you think it's going to do. But when we're bearish, we can really get refined and trade the tops in bear markets because they're predictable. They have a characteristic. They have a rhyme or reason as to why price should behave a specific way. Versus when you're in an extremely bullish market, how do you know? I don't know every single time that they won't go in there and intervene one more time and drive it one more time higher. That's why it's dangerous to try to pick tops in bull markets. But when the market is predisposed to go lower and you have all these types of characteristics in play, it's rather simple to anticipate where the market's going to run, create an extreme, and do a smart money reversal. But that easy perspective that I'm talking about, that comes with 30 years experience. You don't have 30 years experience. Some of you don't even have 5 years experience. So it's going to take a long time, and I mean long time, for you to be able to see smart money reversals as your entry points. Okay, but you don't need that. Anticipate it being there, and then once it does, the market breaks lower, and any rally back up, look at the bodies here, okay? That is what? That's consequent encroachment of the 60-minute fair value gap, SIBI. That's your low-risk short. We're trusting that we've already mohawked above here with these wicks. So now we're back down in here. So any attempt to trade in the middle point of this shaded area here, that could be your low-risk short stop loss right above here. What happens if you get stopped out, ICT? Same thing. Wait for it to go lower, leave the fair value gap low, and if it can touch the bottom of it again, I would use that as my entry. Stop would be right back above wherever the highest high was formed, or the consequent encroachment of the wick if it formed a higher wick here. That's how I would use it. I would not be afraid to go back in, but that low risk is scary for some of you, probably most of you, I'll be honest with you. You would never look to take the trade like that. But how many examples have I done this? I've done many examples of this. So the market breaks lower, and now what do we have? We're on the right side of the curve. That means this hypothetical invisible line where the market trades up during buy-side delivery, trades into our target, where we anticipate the likelihood of a reversal. If the market starts to reverse, then we use the highest high that it forms. To the left of that is what? The buy side of the curve. That means everything leading to buy-side delivery. Now on the left side is what? The sell side of the curve. That means we're in sell-side delivery. What is sell-side delivery going to be aiming for? The original consolidation low. Why? Because it wants to reprice under the original accumulation for sell-side liquidity, the stops that are resting below here. For traders that rode this up, they're married to the idea it's going to the moon, Bitcoin 100,000, that type of mentality. Eventually it drops and goes and attacks them. Okay. So we went above the buy side here to a specific price point. We have a breaker. High, low, higher high, body staying inside of the PD array on the 60-minute. So it's indicating everything is there for this to start dropping, basically. That low is taken out right there. What does it create? Fair value gap between this candle's low, that candle's high. That could be a trade in itself, but this is a breaker. So how far is it going to go back up into it? Right there. So your bearish breaker, that is your first stage distribution. So you want to wait for the smart money reversal. You want to see a low risk short. Does it show a willingness to want to run away? Wonderful. That's tape reading. Now you have a fair value gap and you have a breaker. Trades up into it, go short. That's your first stage distribution. Does it break lower? Yes, it does. Then it does what? It trades back to where we had buy side outlined. Support resistance, folks are going to see that as what? Remember that relative equal high that was a little bit higher than this one to the left? They're going to see that as a break of resistance turn support. That stuff does not work. You have to understand what price is going to do, why it's going to do it, what's the present narrative, and where's the liquidity or inefficiency is going to really draw to. The market rallies up here into a bearish order block, which is the up close candle here. It trades into it, digs into half of the body right there. That's mean threshold. So that bearish order block is your second stage redistribution. This is going to be the fastest elevator ride of the move going down. Now, it doesn't mean it won't be a sharp drop, consolidate lit, sharp drop, consolidate, sharp drop. That it can do that. But this is the one you want to be entered on, because if you miss this one, you're probably going to be chasing price. Now, what happens if you don't see this as your low risk short and you see this as your low risk short, where I had the first stage distribution? Is that wrong? No. Based on your present understanding, you're going to see it probably as this was the first stage of distribution to get short. And the smart money reversal was up here. Wonderful. You don't see a low risk short here in the middle of that PD array. That's okay. That's experience. I understand that you're not going to see everything that I had seen, and I'm making allowances for that while I'm teaching it. So you might see this as your low risk sell or short, and then this is your first stage distribution. So where would the second stage distribution be, or redistribution be? And it's, in other words, instead of saying this one is your second stage redistribution, which means it's going to be the highest degree of speed, magnitude, and impulsiveness to go lower quicker. If it's not this one and you've classified that as your first stage distribution and you're surprised with a sudden drop, you're going to be dazzled because you're on side, and it's probably going to scare you to get out of the trade. If you notice here, I've said that the buy side of the curve used in reverse in the sell side of the curve, meaning what? This down close candle is a bullish order block. So while we were going up, when it drops back down into this, it should be offering what? Support. So when we get to the other side of the curve, which is to the right of this imaginary line, which is divided by the highest high, where we anticipate seeing the market reverse, on the right side of the curve, that's the sell side. So anything on the right side of the curve that was offered as support or as a discount array needs to start acting as what? A premium array or resistance. What's the low of that candle? Draw it through. Where's the body stopping? It's respecting it, isn't it? It's not just simply that bearish order block. We break lower. Same thing here. Buy side of the curve used in reverse on the sell side of the curve. Meaning what? This down close candle, what was it? A bullish order block on the buy side of the curve. But now we're on the left side of the curve where everything should be going lower. So what is going on here? The market's trading right back up to the butt end of that body. Boom. That would be your second stage redistribution. If you looked at that as first stage and this is the low risk short, smart money reversal, and you didn't classify anything low risk, that would be your second stage redistribution. For me, that would be a pyramiding entry. So I would have even more going short. And then we drop down into original consolidation. 80% of the trade would come off. And I would see, do we have the ability to get any deeper? And we can see it goes lower, deep retracement, and finally lower in here. This entire presentation was under the discussion of the British pound versus US dollar forex pair. All of these things here, folks, this occurs on every asset class. It's there all the time. Now, one of the wonderful elements that's not been discussed so far, but I mentioned in the briefing in the beginning of the discussion, is when everything with price is in agreement with time, because time sets the stage. Then price does the act of precision. So it's time and price. Look what's occurring here. On the 31st, we have consolidation. We leave the consolidation, come back in, return to original consolidation. When does that occur? London open. Rallies up. Right in here, we have an order block right there. And then we have what? It rips into the buy side, trading up into New York open, 7 o'clock in the morning. There's your market reversal profile. Part of a market maker sell model, time and price. Everything that was illustrated over here, now look what we're at. We're inside of the New York Open kill zone. We have a breaker. We have a bearish order block, all within what? The New York Open kill zone. This is also optimal trade entry right there. This right here is model 2022. Buy side taken, shift in market structure, fair value gap, go short. That's model 2022. This right here, trading up into that is the 7 o'clock in the morning to 9 o'clock in the morning, New York Open Kill Zone, silver bullet. Man, how many silver bullets? I got a whole rack of silver bullets. Fair value gaps are always forming, folks. You have to understand what the narrative is in play for that session or that operating time that you're using for your trading day. I'm using times of the day that have high intakes of volume, where order flow is increasing. It's rapid. There's a lot of interest getting in the marketplace. So you frame what you want to trade. You want to trade as little as an hour a day? Okay, I've already told you that. You want to trade a full kill zone, 2 hours, 3 hours? Okay, I've told you that too. What did I teach you about the trading day in terms of the opposite end of the range? If the whole idea was to run up, have a market reversal profile, and we have a market maker sell model here, this drop down below these relative equal lows here, what time can it arrive? When can it arrive at the target of reaching below that? London close, 10 o'clock to noon, New York local time. 10 o'clock to noon. Friends and neighbors, that's not random.